All right, welcome to The Explainer. Today we're going to look at climate change through a totally different lens, not just as a problem for the planet, but as a massive driver of business risk and, believe it or not, incredible opportunity. We're going to break down a framework that shows who's really ready for the low-carbon world that's coming.
So let's just dive right in with a really basic question. If you're an investor or just, a curious person, and you want to know which companies are in trouble as we move away from fossil fuels, where's the first place you'd look?
Well, the obvious answer, the one pretty much everyone uses, is to look at a company's carbon emissions. It makes perfect sense, right? The more a company pollutes, the bigger its risk must be. Simple.
But here's the thing. What if that simple, intuitive answer isn't just a little bit wrong? What if it's a dangerous miscalculation? One that could lead you to completely misread who's going to win and who's going to lose in the coming years.
And that gets us to our first big idea here. The way we usually measure climate risk is, frankly, misleading. It's because we're only looking at a tiny piece of the puzzle. To really get it, we need to quickly talk about something called scopes.
So, what almost everybody focuses on are Scope 1 and 2 emissions. Just think of it like this. Scope 1 is the smoke coming out of a company's own chimneys. Scope 2 is the emissions from the electricity they buy to keep the lights on. It's direct, it's pretty easy to measure, and it's what gets reported.
But this is where it gets critical. Scope 3 is, it's everything else. It's the emissions from a company's entire value chain, from the raw materials their suppliers dig up, all the way to you and me actually using their products. And here's the kicker. For most companies, Scope 3 is where the huge, overwhelming majority of their climate risk is hiding.
So you can see the problem, right? If you only focus on that easy-to-measure stuff, Scope 1 and 2, you end up with these massive blind spots. Let's call them the 3 hidden risks of lazy climate analysis.
Hidden risk number 1 is the carbon iceberg. You know how an iceberg works, right? The little bit you see above the water is nothing compared to the giant ship-sinking mass underneath. It's the same thing here. Scope 1 and 2 are just the tip. The real danger, the real story, is in Scope 3. Hidden below the surface.
I mean, just look at a car company. The pollution from the factory that builds the car, it's tiny. The real carbon footprint is the gasoline that car is going to burn for the next 15 years. That's Scope 3. If you only judge them by their factory, you'd completely miss that automakers are sitting right at the epicenter of this whole transition.
Okay, so that's risk 1. Hidden risk number 2 is realizing that not all emissions are created equal. Just because a company has high emissions doesn't automatically mean it has high risk. You have to ask a smarter question. How sensitive is that business to its own carbon footprint? Think about airlines for a second. A short flight, say from Paris to Amsterdam, has a really high sensitivity. Why? Because passengers can just take a high-speed train instead. It's cheap and low carbon. But a long-haul flight from New York to Tokyo, there are no other options. The emissions might be huge, but the actual business risk is way, way lower because customers are locked in.
And the third hidden risk, this one might be the most important. It's just forgetting that companies aren't static objects. They don't just stand still. Looking at a company's emissions today tells you absolutely nothing about its ability to innovate and change tomorrow. And that capacity to adapt, that's everything.
Okay, so if the old way is broken, what's the fix? Well, it's a really simple but incredibly powerful 3-part framework: exposure, sensitivity, and adaptability. Just remember, ESA.
First up is E for exposure. This is all about seeing the whole iceberg. You have to measure the entire carbon footprint, Scope 1, Scope 2, and that massive hidden Scope 3. It just answers the basic question: what is the complete carbon reality here?
Then you move to S for sensitivity. Now that you know the exposure, you ask, so what? How much could this actually hurt the company's bottom line? This is where you translate all those tons of carbon into potential dollars of financial pain. Are new regulations coming? Are customers going to walk away?
And finally, we get to A for adaptability. This is the game changer. It's the forward-looking piece. It's not about where the company stands today. It's all about its ability to innovate, to change, and to cut its own exposure and sensitivity tomorrow. Do they have what it takes to pivot? So let's just dig into adaptability for a second, because this is really where the strategy comes to life. This isn't just about, throwing money at solar panels and calling it a day.
No, the really smart companies are surgical about it. They're looking for what you could call a high carbon yield. For every single dollar they spend on decarbonization, they want to get the absolute biggest bang for their buck. It's about being effective, not just looking busy.
And how can you tell if a company has this? Well, you look for the signs. Is the CEO actually talking about this all the time? Are people's bonuses tied to hitting climate targets? Are they using sophisticated data to find the best solutions? Are they working with their suppliers to solve problems together? That's what a truly adaptable company looks like.
And now, this is where the whole story just flips on its head. Because this ESA framework, it doesn't just show you risk. The exact same forces that are creating all this risk for some companies are creating absolutely enormous opportunities for others. I mean, the logic is super simple when you think about it. Every single company that's facing climate risk is now a potential customer for a climate solution. So all of that risk creates this gigantic wave of demand, and that demand creates a market for anyone who can supply the answers. And these solution sellers tend to fall into two camps. On one hand, you have the pure plays. These are the new companies, the startups, built from day one to be low carbon. Think of a new EV maker. And on the other hand, you have the transitioning giants, the big old school companies that are using all their muscle and money to pivot their entire business to a green future. Think of a traditional automaker going all in on electric.
And this gets us to the real core idea of this whole explainer. The biggest winners of this entire transition probably won't be the companies that just happen to have low emissions today. The real winners will be the ones that create the tools and the technology that let everybody else lower their emissions tomorrow.
So the next time you think about climate and business, stop asking who has the lowest emissions. It's the wrong question. Ask this instead: who has the highest capacity to adapt for tomorrow? And who's building the solutions that everyone else is going to need? Because that's where the future is really being built. So who are you betting on?